The Reserve Bank has signaled more rate hikes ahead. In the video today, we're going to go through their statement on monetary policy. We're going to go through Commonwealth Bank's big breakdown on this, how it's going to impact the economy. There's been some huge announcements that have come out this week that are really going to change and shift the interest rate forecast and even the economy for that matter. Moving forward, Nathan, let's go through the document. The Reserve Bank has changed some of the expectations for wage growth and some revisions, and it really underpins their hawkish shift. What is hawkish policy? An inflation hawk is pretty much a policymaker that uses higher interest rates to keep inflation in check. In this case, the Reserve Bank's trying to push interest rates up so people spend less, so then the costs of things don't spiral out of control. The opposite of a hawk is a dove. It refers to someone who uses interest rates to stimulate the economy, which we saw during COVID. Interestingly, the Commonwealth Bank's forecast compared to the Reserve Bank a bit differs on unemployment. So the Commonwealth Bank's saying that they're saying it's a bit optimistic potentially. Nathan, you saw earlier this week, Commonwealth Bank forecasting only one interest rate hike. It's changed now.
It's interesting. Commonwealth Bank changed their tune up until the last rate rise that happened this month in February. They're actually saying that this was going to be the last one. We're not going to see any more. And Westpac, ANZ were both saying, no, we see the cash rate hitting 3.85%. So they've said that since last year that we'd ideally see 3 more rate rises this year. Commonwealth Bank has changed and now agreeing with the bigger banks and saying we're going to see another 2 rate rises and the official cash rate is going to hit that 3.85%. So interestingly, 3 of the 4 big banks are saying the same thing. NAB's forecast is a little bit more optimistic. They're saying 3.6 is where they see the cash rate hitting.
Interestingly, the Commonwealth Bank still think policy easing is going to be required in Q4 of this year, 2023, to see us avoid a recession, basically a hard landing.
And you've got to remember when COVID happened, 2020, there was a bunch of variable rates, fixed rates that were taken up, and the assessments were based on borrowers' ability to repay a loan if interest rates hit 5.25%. We saw the cash rate lift this month in February. That's taking official variable rates in and around that 5%. 5.10s, 5.25s. Now we're getting in uncharted territory. Another rate rise in March would actually see that those borrowers that were assessed at their affordability and limit at 5.25 are now actually over that limit and in uncharted territories.
Yeah, it's definitely echoed here with the Commonwealth Bank's own policy saying the monetary policy works with a lag and the Reserve Bank is flying blind given they've been put through an amazing amount of tightening. There's all these people coming off fixed rates over the next little while. In addition, a fifth of mortgages are fixed under low rates and are going to expire this year. And it means there's that sort of lag effect that's coming through.
We saw 60% of mortgages during 2021 fixing in, which means all of those fixed rates are now coming up and they're facing a 60% increase on their mortgage repayments. That's just astronomical. And we're probably yet to see the worst of it because Commonwealth Bank has said that there's that lag effect. There's still a bunch of people on that honeymoon where they're locked in, they're experiencing those low repayments, and they haven't actually felt the effects of all these 9 consecutive rate hikes on their bottom line.
The CBA has changed their tune. They're saying the Reserve Bank's going to increase by 0.25% in the March and April board meetings. But again, they reiterate at the end there that they think that the Reserve Bank might overstep a little bit because of the impact of some of these fixed rates coming off, the lag effect that they think that it's likely and it's potentially the Reserve Bank will start cutting the cash rate later in the year to avoid a recession.
I think a key driver here is how quickly inflation starts to come down. The good thing is inflationary data is being posted every month. Previously, it was every 3 months. And what that means for the Reserve Bank is if they get the data for January, we can start to get a feel if inflation is starting to come down, if the Reserve Bank's movements with the cash rate is working, or if they need to keep going hard.
This is in line with the Commonwealth Bank, and what they're saying here is they're saying they're actually quite optimistic on unemployment and too pessimistic on inflation. They're potentially saying the Reserve Bank's forecasts look too positive given some of the GDP figures and expect inflation to recede actually a lot quicker than what the Reserve Bank's saying. And we'll include this report below in the link below, but the crux is saying basically the Reserve Bank's going to increase rates because they've increased them so quickly. It's going to have an impact to people employing staff because they have to keep the cost of living up, and it's going to slow down overall. An interesting part of the statement also includes some focus on topical issues, including the mortgage payments in advanced economies and how far they are ahead and comparing Australia to some of the other banks. This chart is of particular interest. It does note the transmission of monetary policies. The amount that the Reserve Bank has increased interest rates has had an impact in Australia a lot quicker than other economies like New Zealand, there's Norway, Canada, etc. This is even after accounting for the lag effect. What it says here with the data is although the Reserve Bank were quite late to the party, New Zealand had started raising rates in 2021, Australia only started in 2022. This has actually had a bigger impact than most other economies. the Reserve Bank's actually tightened more aggressively than others because of the way the Australian mortgage market is structured. For instance, the average outstanding mortgage in Australia has increased by 50 basis points more than in New Zealand, despite the cash rate being 100 basis points lower. And that's because of the fact that 70% of Australia's mortgages are variable, while only about 10% in New Zealand are. These cash rate increases are going to have a much quicker and much pronounced effect on the Australian economy and Australian mortgage holders, and potentially, I guess, they can roll it back as quick as they put it on if they have to.
So that's it for today, guys. Here at Hunter Galloway, we get mortgages approved. So if you're looking for a great mortgage broker, we can help. Call us on 1300 088 065 or visit our website huntergalloway.com.au, hit that contact form, and guys, thanks for watching.